The market looks strong again. Headlines are celebrating the rebound. Investors are breathing easier. Confidence is starting to come back. But here's a question no one's asking. What if the recovery is being carried out by only a handful of stocks? Because sometimes a market can look healthy on the surface, while underneath it's far more fragile than people realize. Let's take a look at this chart. Since April 1st, the S&P has rebounded by roughly 12.5%. That's great news, but let's take a look closer. Just 5 companies, Alphabet, Nvidia, Amazon, Broadcom, and Apple, have accounted for nearly half of that entire market recovery. Think about that for a second. 5 companies doing the heavy lifting for an index made up of 500 stocks. Meanwhile, the other 495 companies, they only contributed about half. That's an incredibly concentrated recovery. And while concentration can drive markets higher, it can also reverse quickly. Because when leadership becomes too narrow, the market becomes more dependent on just a fewer names that are going to hopefully continue to perform perfectly. And the reason this matters is because concentration risk, that's one of the biggest hidden risks investors face today, especially during strong rallies. When markets are broad and healthy, gains tend to spread across sectors, industries, and company sizes. But when there's only a few mega cap companies driving performance, the margin for error shrinks. A disappointing earnings report, a slower AI growth, regulatory pressure, right? Any shift in investor sentiment can suddenly have an outsized impact on this whole entire market. Look, the recovery is real, but the structure underneath the recovery matters too. That's exactly why we continue to take a risk-first approach. We don't want portfolios relying on 5 companies having a perfect year. Instead, we focus on diversification, disciplined allocation, managing concentration risk before it becomes a problem, because leadership rotates, winners eventually change, and portfolios built only around yesterday's leaders often struggle when the market environment shifts. There's an old Wall Street proverb, trees don't grow to the sky. So there's 2 things we've got to remember here. First, strong markets don't always mean broad markets. And second, diversification may feel boring during concentrated rallies, but it becomes extremely valuable when momentum eventually changes direction. This is Aaron Howard. This has been your weekly market update. Thanks for watching, and we'll see you again next week.